Okay, everyone, grab a coffee and sit down. This is going to be longer than usual. Not because I have one massive story, not because something broke the internet or the entire profession overnight. What happened instead is that we got 5 major developments, all made up in small steps, and all in the same 7 to 10 days, all pointing in the exact same direction. And when you stack them up, the picture becomes impossible to ignore. Let's take a look. Let me walk you through what happened and what it means for your practice. And at the end, I'm going to show you the one decision that changes everything. So here's what you need to see first. PwC just drew a line in the sand. Paul Griggs, the CEO of PwC US, said something that would have sounded extreme 6 months ago. He said partners who resist AI adoption have no place in this firm. Not should consider it, not might want to explore options. No place. He said it plainly. Anyone who thinks they can opt out, they are not going to be here that long. And that alone would be headline news. But here's what makes it different. At the same time, PwC is issuing that mandate, they are simultaneously restructuring how they pay partners. Bonuses now track revenue and margin per professional, not hours. Revenue and margin. And leaders are being measured directly on how fast they move services to AI. The firm is hiring fewer traditional accountants proportionally and bringing in more engineers and data specialists. This tells you something important. PwC isn't making an ideological argument about AI adoption. They're making an economic argument. They are saying the work that used to generate revenue, the traditional accounting work, is being automated. So we need to pay for results, not hours. And we need people who can build and operate that automation. When Sequoia Capital published their framework, I call it their manifesto, a couple of weeks ago, arguing that most professional services work is actually intelligence work, not judgment work, most of the profession didn't really move on it. It was a Sequoia piece. That's interesting, it's academic, but PwC just confirmed the thesis in real time. The largest professional services firm on the planet is telling its partners, the intelligence layer of your work is getting automated. The only defensible position is the judgment that sits on top of it. But here's what should concern every smaller firm, which is all of us. PwC didn't just issue a mandate. They dropped a product. They launched something called PwC One. It's a self-service AI platform offering tax compliance and consulting intelligence on a subscription. No hourly billing. Now, PwC's partner rates, most mid-market companies cannot afford to pay those rates. But if you know what they can afford? A subscription to PwC One. If subscription price self-service advisory scales, it competes directly with the advisory services that firms like yours and mine sell. That's not theoretical. That's tomorrow. Okay, now moving on. Your bookkeeping vendor just started learning from you. This is real. Dext launched something called AI Assist on March 23rd. It's an AI agent built into their platform that watches your team's corrections. Every time someone categorizes a transaction, every time a sales tax rate gets fixed, every time you apply a tax rule, the AI builds a permanent rule from that correction. And that rule applies to every future transaction like it. This is different from AI does your bookkeeping. This is self-learning at the vendor level. When your bookkeeper fixes a sales tax rate, something that happens constantly in jurisdictions like Canada, the UK, Australia, and New Zealand, the correction doesn't just fix one transaction. It becomes a rule that applies to every similar transaction going forward. That's material. A wrong tax rate means an audit exposure. Having corrections compound and stick is useful. But here's what I need you to hear. Dext processed 31.4 million receipts and invoices last month. The AI Assist is designed to push that number higher. And the pricing? Well, free trial through late April. Then £5 per client per month for accountants. Free for the business owners using Dext Solo. Now hear that again. The accountants who teach the AI through their corrections pay. The clients who benefit from that collective intelligence don't. Dext is monetizing your expertise back to you while giving it to our clients for free. That's a pricing structure worth questioning. And here's the bigger question. Every correction your team makes inside Dext builds Dext's AI, not yours. Your expertise makes their product better for everyone. Whether that trade-off is worth £5 per client depends on whether you're building parallel context in systems you control. Your accounting platforms are picking sides. Both of them. Last week, Intuit signaled a multi-year deal with Anthropic to bring Claude into QuickBooks and TurboTax. This week, Xero did the same thing. Same provider, one fortnight. Xero and Anthropic announced a multi-year partnership that works both ways. Claude's reasoning now powers Xero's AI assistant for cash flow analysis, invoice tracking, revenue performance. And Xero's financial data flows into Claude. Business owners can ask questions about their books directly in Claude without leaving Anthropic's platform. 2 of the 3 major accounting platforms. Same provider, same month. That's not a feature upgrade. That's a platform convergence event. The infrastructure layer of your profession is consolidating around a specific AI provider, and the integrations are bi-directional. Your client's data doesn't stay inside Xero or QuickBooks anymore. It flows into Claude, where it can be analyzed, modeled, and acted on by anyone with access. For CAS practices, this is the AI in the gap story accelerating in real time. We've been saying that the gap workflows, the work between your platforms, are where AI has the highest leverage for you. These partnerships are closing the gaps from the platform side. Xero and Intuit aren't waiting for practitioners to bridge the space between tools. They're building the bridge themselves, with AI on both ends. The question for your practice is simple. Are you the one directing that traffic, or are your clients doing it without you? Now, Anthropic, the company behind Claude, had its wildest week in history. Product velocity met corporate chaos. Over the past few weeks, Anthropic removed every friction point between I have a task and AI is executing it autonomously. Dispatch lets you send instructions from your phone while Claude Coworker works on your desktop. Computer use lets Claude operate your actual applications, not just your browser. It can click buttons, fill in forms, navigate software on your desktop. Projects in Coworker give persistent context that survives between sessions. Scheduled tasks let Claude run work on a timer without you present. And Claude Code added Telegram and Discord channels so you can interact from anywhere. Now, each one individually is a feature update. Together, they're building the always-on autonomous AI coworker, one that works when you're not at your desk, remembers what you did last time, operates your tools directly, and runs on a schedule. For CAS practices already using Coworker, this changes what you can delegate. Queue up reconciliation prep from your phone during a commute. Schedule a weekly document organization task. Let Claude work through a batch of client files while you're in meetings. The asynchronous, autonomous, device-agnostic workflow didn't exist a month ago. But here's the backdrop. This week, Anthropic had a data breach. An unsecured CMS revealed nearly 3,000 unpublished assets, including something called Claude Mythos, Anthropic's most powerful model ever. The company confirmed it's real. They called it a step change, dramatically outperforms Opus on coding, reasoning, funnily enough, and cybersecurity. The irony, right? A model flagged internally for unprecedented cybersecurity risks was revealed through a basic security failure. That's the kind of irony you just can't make up. The same week, Anthropic won a preliminary injunction against the Pentagon. The DoD had designated them a supply chain risk after Anthropic refused to grant unfettered access for autonomous weapons and domestic surveillance. The judge called it a First Amendment retaliation. And Bloomberg reported Anthropic is in early IPO discussions, maybe as soon as October, raising potentially $60 billion or more. Leak, lawsuit, IPO, all in 1 week. The product velocity is real and directly useful for your practice. The corporate turbulence is worth watching, but it doesn't change the calculus. The IPO signals maturation. Public companies have quarterly accountability, predictable roadmaps, more enterprise features. That's good for practices building long-term on these platforms. And the Mythos League actually strengthens a point we talk about constantly. More capable models produce more convincing output. That makes professional review harder, not easier. The judgment edge, which is your ability to know when something is wrong, becomes more valuable, not less. All right, AI economics are meeting reality, and this is where it gets practical. OpenAI killed Sora, their AI video generation platform. Estimated cost, $15 million per day, $5 billion annually. The Disney partnership, unwound. No money ever changed hands. OpenAI is consolidating around coding and enterprise. That's it. The AI Daily Brief said it right. Nothing kills a business faster than the sunk cost fallacy. Even OpenAI, with massive funding, has to kill products that don't deliver ROI. Side quests die. Core products survive. Meanwhile, vertical AI models, domain-specific AI built for accounting or customer service, are outperforming frontier labs in their own spaces. Cursor's Composer, built on open source models, matches the newest OpenAI model at a fraction of the cost. They ship improved versions every 5 hours. Intercom's Fin service resolves nearly 2 million customer issues per week. Decadon runs 80% of its traffic on in-house models. This pattern is unmissable. Companies that take open models, post-train them on domain-specific data from real interaction logs, outperform the frontier labs in their vertical. And when someone does this for accounting, when a company builds domain-specific post-trained models for your profession, the economics shift permanently. Basis at $1.15 billion in valuation and Accrual with a $75 million raise are early candidates watching this space. One more data point. MCP, the Model Context Protocol that underpins the Intuit and Xero integrations, hit 97 million monthly SDK downloads, up from 2 million 16 months ago. Now governed by the Linux Foundation, the plumbing is in place. Everyone is building on it. Okay, quick hits before I close out. I know it's been a long episode. Gemini 3.1 Flash Live brings real-time continuous dialogue to voice AI. No more turn-based awkward interactions. Home Depot is using it. Apple is using it for the new Siri. For CAS practices, voice-based client interactions are a gap workflow that just got better infrastructure. ARC AGI 3, a new reasoning benchmark, dropped frontier model scores to near zero. A useful reality check. The things AI still cannot do, novel reasoning, contextual judgment under genuine uncertainty, those are precisely what make professional judgment valuable. And Shopify launched Tinker, a free app with 100+ AI tools for e-commerce merchants. Your clients' vendors are giving them AI capabilities whether you're helping them or not. So here's what matters. None of this is one big thing. It's a dozen smaller things pointing in the same direction. PwC restructured around AI. Dext is learning from your corrections. Xero and Intuit are routing your client's data through Claude. Anthropic is building the always-on autonomous Coworker. Vertical AI companies are outperforming frontier labs, and the economics are tightening. Even the biggest players kill what doesn't deliver. The accumulation matters more than any single headline. The question isn't whether you adopt AI, it's whether you're building context that compounds in systems you control. Or watching your platforms, your vendors, and the largest firm in your profession build it without you. That's where my AI in the Gaps Toolkit comes in. It walks you through the entire system. How to identify gap workflows in your practice. The work between your platforms, where AI has the highest leverage. How to map those workflows into repeatable processes. How to integrate AI without waiting for your platform vendors, and how to build context that compounds in systems you actually own. It's a simple toolkit. It's a sample prompt and lots of ideas. That toolkit is designed for practitioners who want to move. Not next year, not next quarter, now. So download it, walk through it. Let me know what you build. The link is in the description. Tomorrow, I'm going to present my entire Sequoia Manifesto webinar and give you all the technical details in case you missed it. And Wednesday, I'm going to analyze that PwC One product and tell you what that means for your practice. So we'll see you then.